If you're constantly chasing high-yield savings account rates or rebuilding CD ladders every time rates change, you're probably doing more work than you need to. Most people think that those are the only safe places for short-term cash or emergency funds, but professional investors almost never use them to park cash. Instead, they rely on highly liquid, low volatility funds and ETFs designed for daily access, competitive rates, and critically, better state tax efficiency. Today, I'm breaking down some of the best short-term funds for parking cash. What are they, how they work, and when they actually make sense. Okay, first up is one that's been a long-time favorite of Warren Buffett and Berkshire Hathaway, U.S. Treasury bills. Buffett has always preferred buying T-bills directly from the government auctions, mainly because when you're moving hundreds of billions of dollars, even a tiny fee can turn into millions in lost interest. For the rest of us, though, buying T-bills directly just isn't necessary. Using an ETF like SGOV or Vanguard's VBIL is a much simpler and more convenient way to get the same result. You still get the government-backed safety. You just buy the ticker and let the fund handle all the busy work for you, with very low fees. SGOV has an expense ratio of 0.09%, and VBIL just charges 0.06%. On a $10,000 investment, that's only $9 or $6 per year. Let me take a quick moment here to say I'd really appreciate it if you hit the like button, and don't forget to leave some comments below. It does help support the channel, and I would sure be grateful. Okay, so SGOV has been around since 2020, and Vanguard's VBIL launched in February of 2025. Both invest in ultra short-term U.S. Treasury bills with maturities between 0 and 3 months. SGOV averaged returns of 5.13% in 2023, 5.28% in 2024, and 4.24% in 2025. Because they invest in essentially the same treasuries, Vanguard's version has performed almost identically since it has launched. And during the first quarter of 2026, both have been yielding right around 3.5 to 3.6%. One of the biggest advantages here is taxes. Interest from U.S. Treasuries is generally exempt from state and local income tax. That can be a big deal if you live in a high-tax state and you're holding this outside of a retirement account or something like an HSA. One quick note here, though. These funds can generate a small amount of non-treasury income, which is subject to state taxes. That portion is usually very minor, though. For example, in 2024, about 97.53% of SGOV's income was exempt from state and local taxes. By comparison, interest from CDs or high-yield savings accounts are both taxed at the federal and state level. With T-bills, the state tax portion stays in your pocket. One quick clarification so there's no confusion, though. Even though SGOV and VBIL pay monthly income, the IRS does treat it as ordinary income for federal taxes, just like CDs and high-yield savings accounts. You're not getting the lower qualified dividend rate here. The real benefit shows up at the state level, where the Treasury income is typically tax-free. In high-tax states, that can be a noticeable boost to your after-tax yield compared to traditional bank accounts. Another big plus is convenience. Instead of constantly chasing new high-yield savings accounts when rates change, these ETFs automatically roll their holdings into new short-term T-bills for you. They're also extremely liquid. Shares trade just like a stock, so you can access your money any day the market is open. And since they pay monthly income, they provide a steady, predictable cash flow. Now keep in mind that these are not the best for long-term investments. The share price stays very stable over time. If you look at a one-year chart, it may look a little strange, and that's because of the monthly income payments. Using SGOV as an example, the share price stays very close to $100. It gradually rises as interest accrues and then drops back down after the monthly payout, and this cycle keeps repeating. But a key point here is this: if your short-term money or emergency fund isn't earning anything, inflation is quietly eroding its value. Funds like SGOV and VBIL are one way to keep that cash working without taking on unnecessary risk. 3 other similar ETFs in this category are CLIP, run by Global X, Vanguard's VGSH, and BIL, BIL, and that's issued by State Street. The main difference is they focus on 1 to 3 month Treasury bills instead of 0 to 3 month. But they have very similar performance and come with extremely low expense ratios. Now, I'll be honest, I'm really not a fan of general traditional bond funds, but ultra short-term Treasury bill ETFs are a different animal and work well for emergency funds and a place to park cash for a bit. They hold government T-bills, they're extremely stable, your money stays liquid, and they're backed by the U.S. government. A good example is in 2022. That's when the S&P 500 fell 18%, and popular bond funds like Vanguard's BND and the U.S. Aggregate Bond ETF AGG were both down over 13%. During that same year, SGOV still managed to post a small gain of about 1.6%. And that's exactly what you want your short-term money to do. Stay steady when everything else is falling apart. Now, if you're willing to step just outside the very safe T-bill circle in exchange for a little higher yield, you can look at other ultra short-term bond ETFs. Funds like JP Morgan's JPST, Vanguard's VUSB, T. Rowe Price's TBUX, PIMCO's MINT or Mint, and Prudential's PULS fall into this category. Unlike pure T-bill ETFs, these funds don't only hold government debt. They also include high-quality investment-grade corporate bonds, commercial paper, and sometimes asset-backed securities to boost your monthly income just a bit. You're essentially trading a small amount of government-backed safety for a bit more yield. The key point here is that these funds keep their duration extremely low, usually under 1 year. That means they're not very sensitive to interest rate changes, so prices tend to stay relatively stable compared to other traditional bond funds. You give up the state tax exemption, though, that the treasuries provide, but in return, you typically get a little higher yield, expense ratios remain very low, and the overall risk is still very modest. If you look at their performance over the past 4 full years, you see that from 2023 through 2025, they delivered solid, consistent returns, generally higher than pure T-bill ETFs. In 2022, a couple were slightly negative due to the corporate bond exposure, but PULS and JPST still average roughly 1 to 1.5%, compared to the 13% loss in the broader bond market. They held up remarkably well, showing just how stable these funds can be, even during high inflation years. So yes, in exchange for a higher yield, you're giving up a small margin of safety, but these funds are still far more conservative than most bond funds and are generally considered low-risk options for short-term money. So after looking at all these options, which would you actually pick? Here's how I would break it down. If this money absolutely cannot take any risk, think of emergency funds, money you might need to use in the next few months, or cash you simply want to protect. Then funds like SGOV, VBIL, BIL, or CLIP are usually the better fit. These are pure Treasury bill ETFs. They're backed by the U.S. government, extremely stable, highly liquid, and they come with the added benefit of being exempt from state taxes. If you live in a high-tax state, That's a nice automatic raise on your yield. For true sleep-at-night money, these are great choices. On the other hand, if you're comfortable taking a very small step up the risk ladder in exchange for a little more yield, that's where the funds like JPST, VUSB, Mint, T-Bucks, and PULS come into play. These still focus on ultra short-term durations and low volatility, but they add high-quality corporate bonds to boost the income a bit. They're a good fit for short-term money you don't expect to need immediately. Maybe cash you're holding for a year or two, or money that's part of a broader allocation rather than your core emergency funds. The biggest mistake I see people make is letting short-term cash set idle or consistently chasing bank rates. It's a lot of work for very little benefit. Inflation quietly eats away at idle money. Using the right short-term fund is simple and keeps your cash working for you without taking unnecessary risks. As always, think about your time horizon, your tax situation, and how quickly you might need this money. The best option is one that lets you stay comfortable, consistent, and disciplined, no matter what the market is doing. But I would really like to hear from you. Where do you like to keep your emergency fund and short-term investments? Let me know in the comments below. And if there's other funds that I didn't cover today, please feel free to share those also. Thank you so much for watching, and I'll see you next time.